How does Celtic cover work? This is one of the most common questions we get at Kiander, and I'll explain it to you in less than a minute. Sell to cover is all about supply and demand. In a sell to cover transaction, the company sells shares in order to raise cash to cover employees' tax obligation. But first, the company has to think about four really important things: the number of shares it needs to sell, the timing of that sale, the demand in market, which basically means who'll buy those shares, and the speed and structure of the transaction. But at the end of the day, it's all about the basics. A successful sell to cover matches the supply with the available demand. As an issuer, you know what the supply looks like. You know how many shares you need to sell because you know the dollar amount of taxes your employees owe. But very often, issuers forget to think about the available demand. If you're selling a set number of shares, who's going to buy them? And if you don't think about both of those sides, what could end up happening is your stock price could decline. Why do stock prices go down? Well, usually because of too much supply. So if you're running a sell to cover program and you notice that you are currently getting hit with a market impact of stock price decline, it's most likely because you're introducing too much supply. In a scenario where we have too much supply and no available buyer, and the stock price goes down, this also means that your employees will now have to withhold more shares in order to meet their tax obligation. So everybody loses. The stock price goes down, which is horrible for employees and shareholders alike. And now you also have to withhold more from employees, and they worked so hard to earn those shares. Now, a mismatch could happen for one of three reasons. The most obvious one is too many shares and not enough buyers. But the two less obvious ones are usually the culprit that is harder to figure out. Sometimes selling a lot at once could create a spike of supply. So even if we had demand available, now that demand is going to disappear because folks got spooked that there's too many shares coming in the market all at once. Another really big issue is selling at the wrong time. Usually, for most stocks, there's most volume in the beginning of the day and the end of the day because that's when traders trade. In the middle of the day, it's pretty quiet. So if you're pushing a lot of shares in the middle of the day, you're actually creating your own market imbalance. If you're in this situation already, it's time to think about solutions. And the most important place to start is knowing your stock. Sell to cover can be mapped ahead of time based on the historical supply and demand patterns of your stock. Remember, we're always thinking about supply and demand. We're going to measure once, twice, and cut once. How much stock are we selling? Is the market able to ingest it? Those are the two questions you should be asking yourself every quarter as you're thinking of this. And there's a lot of alternatives to start exploring. If your sell to cover is reducing the stock price, this becomes a board level shareholder value issue. And you could explore things like how it's traded, what limits are set on the trading, should you structure the transaction, how you should think about settlement, what is the trading method, what is the timing. There's a universe of options available to you. But first, you have to remember the golden rule of supply and demand. Until the next video.